Hello. Good evening, sir. Good evening, Sandeep.
Hello.
Good evening, Sandeep.
Good evening. Good evening. Good morning, sir. Good evening, sir. Good evening, sir. Good evening, Gunjan.
Good evening. Good evening.
कैसा रहा मैराथन?
अच्छा था. It was good.
अच्छा. कितना दौड़ी? 7 और हाफ मैराथन.
नहीं पहली बार था 7 का है. 7 किलोमीटर दौड़े थे. नेक्स्ट टाइम टारगेट है हाफ मैराथन का. लेट्स सी.
हाँ. Good.
Okay, ji, I just sent you the link for desktop sharing.
हाँ.
Okay. ji.
असाइनमेंट करेंगे उत्तम.
Yeah, okay. Not a problem.
लंबा पढ़ने का काम था और फिर वो ये पाया.
Okay, not a problem. Actually, next week, let's try to finish it before next week. So,
I want to do it.
so actually, only Shankar sir has sent his PowerPoint and doubts. Okay, so you and Gunjan needs to finish it before next class. So in the next class, we will discuss whatever doubts we have pertaining to those two chapters, and any other doubt you have. Okay, ji.
Next class will be sort of a consolidation class and bookkeeping.
Okay.
Right?
Yeah, exactly, sir. So it will be, it will consolidate all the things we have learnt till now.
आपके मेल आई थी.
And it not in the mail, sir. It's in the Skype text box.
अच्छा Skype पे.
हाँ जी, sir. Okay, ji. So I think everybody has joined. So are you guys able to see my screen?
Yeah.
Okay, ji. So obviously this time, like, we are not going to discuss anything related to assignment. So let's start with what we discussed in the last class. So it will be a 2-minute recap of what we did in the last class. So in the last class we talked about general ledger, and we said that it is collection of all the ledger accounts. And then we talked about, like, what is ledger account. It is like listing of all the hello. Somebody is disconnected. Gunjan is disconnected, I think. Okay, anyway, let's continue. Okay, so we said that T account lists all the increase and decrease in a particular account. Okay, then we talked about the balance of ledger account. So we said that, like, there are two types of accounts. You have debit balance account and you have credit balance account. So balance of a debit balance account will be debit minus credit entries, and balance of a credit balance account will be credit minus debit entries. Okay, ji. So let's mute all the mics. Okay, so that we don't have noise. And then we talked about posting process, and we said that the data from either the day book or from the general journal is posted into the ledger accounts. So data from you have general journal and then day books, and they are going into ledger accounts. Okay, and we said that to link all the data between the two, like, how do you know that which record in general journal is linked to the entry into the ledger account? So that is done using cross referencing. So we are talking about account number, entry number, date. So these are the ways to cross-reference entry into general journal and day books into the ledger entries. Then we touched upon bookkeeping in computerized world, and we said that like previously it used to be very a step-by-step process, that this step will be carried out first, and then the data will flow from one type of document into the another kind of book, and then from the second book into the third book. But due to computerization, like now the data is directly entered, like as soon as the transaction is created and it is verified and validated by the correct authority, it is directly flowing into 2-3 places. So that was the major difference. So it reduced the need for different people handling before it goes into the next system. Then we talked about special journals, that is day books. Like why do we have day books? So first of all, like what is the need? So we said that whenever like we have very common type of transaction, we already know like what will be the debit entry, what will be the credit entry. So why do we need to generalize each and every time writing 2 lines? So when we are entering the data into the day book, only one part of the transaction is noted down, and then when we are posting the data into general ledger, at that point of time the second part of the entry is also captured. And the other reason was division of labor, that if you have say 10,000 transactions every day, and if only one person is working on that, then they will not be able to complete everything in one day. So that was the need. And then the basis was that transactions of similar nature, and they must be repeatable. So the number of transactions should be huge and they should be the same nature, so that as soon as I say that you have to enter data into a particular day book, you already know what is the nature of that transaction. Okay, so that, and then we talked about advantage, like what is the advantage? Efficiency of bookkeeping process, division of labor. So those were the few advantages we talked about. And then lastly we talked about control account. So we were talking about like different customers or different suppliers. So we said that whenever we are selling goods on credit, we will have accounts receivable. So there will be some amount we will receive from each customer. Okay, so that will be recorded at the customer level, but there is a control amount which sums up all the amounts receivable from different customers into a particular amount, and that is known as control account. So at any point of time, the debit entries or debit balance of all account receivable should match the debit balance in the control account. Similarly, if we have huge number of suppliers, say 100 suppliers are there in a business, so for each of the supplier, whenever you are purchasing goods on credit, you will have accounts payable, and there will be a control account. So once again, control account will have the credit balance which will match the sum of all the credit balances in the individual supplier accounts. So is there any doubt related to the previous class? Sandeep and Gunjan?
So far so good.
Gunjan, are you there?
Yeah, I had one doubt.
Go ahead.
If I go to your lecture 4, slides in lecture 4, we're discussing about the T account.
Okay.
In the last class, I saw the recording. Sandeep also had that doubt, which you cleared, but I couldn't get it. It says that increasing and decreasing. If you see slide number 8.
Yeah, okay, I remember that.
The T on the left hand side and the right hand side. The order.
Yeah, okay. So, okay, let's talk about that. Like, suppose you have a cash account. Okay, Ji. So, this is cash T account. And suppose you borrowed money from the bank. So, this is debit side, this is credit side. So, if you borrow money from the bank, what will happen? Will the cash increase or will the cash decrease?
The cash will increase.
So should we debit it or should we credit it?
Asset increases debit.
So suppose I borrowed $10,000. So if we are capturing that into the cash, so we will say that cash is increasing. Similarly, suppose you have owner's equity account. Say you are the owner of the business and you are putting additional money into the business. So this is debit and this is credit. And once again you are adding $10,000 to the business. So what will happen to the owner's account? Is owner's equity increasing or owner's equity decreasing?
Owner's equity, he has put some amount, right? He has contributed to the
Yeah, additional contribution. Yep.
additional. Owner's equity will increase.
Yeah. So will it be debit or will it be credit?
It could be credit now.
Yeah. So what do you say? That if you have if you want to note the increase, sometimes you have to put the data inside credit, and if you want to increase the value of a particular account, you have sometimes debited. So that's why I said that increase in a particular account doesn't mean that it will be always a debit entry. So increase will be either debit or either credit. Okay.
So basically,
So that was what I wanted to say.
okay, yeah, got it.
Okay, ji.
Yeah, I do have another doubt.
Yeah, okay, go ahead.
Go to number 10, the balance of a ledger account.
Okay.
Asset accounts have left side balances. What does that mean?
Okay, so suppose at the end of a particular period, you want to know that, say at the end of the month, you want to know how much cash you have. Okay, so how do you get how much cash you have in the business at a point of time? Where will you look into? Which account will you look into? If you want to know outstanding cash you have in the business,
Assets.
where will you look into?
We calculate the assets which we have.
No, I am talking about cash. Which account will you look into? Cash account or any other account? You will directly look into cash account, isn't it?
Cash account.
And you will find that there are many entries, debit entries,
Okay.
and you will find the credit entries.
Yeah.
And you will sum it. Say sum 1, this is sum 2. So will you do sum 1 minus sum 2, or will you do sum 2 minus sum 1 to know how much money you have?
I'll do some credit minus debit.
Why credit minus debit? Okay, give me the reasoning.
Because cash account it is credited.
In cash account, is debit entry increasing the value of the cash, or is credit entry increasing?
Debit entry increasing the value.
Okay, so it is always for any account, whatever side is increasing the value of the account minus, so S1 is increasing, this is debit side, so it is the balance of cash. You will have balance is equal to S1 minus S2. Okay, ji. So this is called debit balance account. Okay, ji. And here the amount you have is S1 minus S2. What about owner's equity? If you want to know at the end of the day, and suppose this is Gunjan's owner's equity, and you want to know how much total contribution you have into the business, so will you do S1 minus S2 or S2 minus S1?
S2 minus S1.
Yeah, okay, perfectly fine. So you will do S2 minus S1. So is it a credit balance account or is it a debit balance account?
It will now be a credit balance.
Yeah, so owner's equity, it's not about now. It's like all the liabilities and all the owner's equity accounts are credit balance account. Similarly, if you look at all the assets, all of them are debit balance, or we can also say left balance account. Is it clear to you?
Yes.
Any other doubt?
No.
Okay, ji. So let's have a look at the terms we learnt in the last class. General ledger, ledger account, debit balance account, credit balance account, posting, cross-referencing, special journals, day books or subsidiary books, cash book, purchase, this will be purchase return book, then sales book, sales return book, journal proper or general residual or general journal. So these are the three names for the same book. Then subsidiary ledger, and then we talked about control account or master account. Okay, so these were the terms which we dealt with in the last class. So today we will talk about trial balance, then we will move on to closing the books, and then we will talk about adjusted. So what is the meaning of adjustment? So we will talk about this, and then we will talk about preparation of financial statements. Okay, so how do we make financial statements once the trial balance is ready? So this is a very simplified bookkeeping process shown to you. So we just recap to get the feel of it. So you have transaction documents, moving on to journal or day books, then ledger, then you have the trial balance. So this whole part is bookkeeping process. Okay, so now we are moving into preparation at the end of the period. Okay, so when does this take place? So whenever you want some kind of financial reports, for example in USA or even in India, you have quarterly reports. So at the end of 3 months you want to churn out some reports, okay, and which will be published. So how do we do that? So that starts with preparation of trial balance. Okay, and then once the trial balance is ready and validated, then we churn out financial statements. Okay, so let's see what is the meaning of trial balance and how it looks like. So trial balance is though it is a fancy name, but it's simply listing of all the accounts in the general ledger. When we say general ledger, means here like we are talking about all the day books, if they are holding on to replacing general ledger account. So here like the meaning is whatever accounts you have which captures transactions of the business. So listing of all those accounts and their balances. So what are the two items you will have? You will have account title, like what is the name of the account, and then you will have what is the balance. Okay, what is the balance in that account. So it is listing of all the account titles, and then on this side you will have balance. And balance also you will have first debit. It is always the convention, the debit, and then after that you will have credit. So if a particular account title is debit balance account, so you will see a debit balance, and suppose this particular account title is having credit balance, so you will have credit balance. Okay, and debit balance will be left. So we will see in the next page the example, then we will get better idea. So let's see one example before we discuss other points. So this is a very simple trial balance, like this is a dummy trial balance shown to you. So here what do you see? There are two columns. One is, this is known as account title, and these are the balances. Okay, so cash is a debit balance account, so you see the debit entry here. Similarly for all the assets you see a debit balance, and then you have liabilities. So liabilities, you see the liabilities and owner's equity is shown as credit balance. Okay, and one more convention you see that here, first of all the, if you look at all these things, these are balance sheet accounts. Okay, so when we say balance sheet, all the asset accounts, all the liability accounts, and all owner equity accounts, so those are listed first, and at the end you will see all the income statement accounts. So for example, revenue, expenses, so all the revenue and expenses. So this is just a convention. Okay, so you have income statement and then you have balance sheet accounts. So let's go through it. So what is the objective of trial balance? So at the end of the period, you get all the account titles and their balances. So before you prepare the financial statement, you want to verify that have you captured all the transactions correctly or not. So what will be the problem if all the transactions are not captured? The problem will be that all the debits may not match with the credit. It may not necessarily be true. It may would have happened that like we made a mistake in debit also and in the credit also, but at least it will be able to catch any incomplete transaction, or by mistake if you entered wrong amount in debit and credit for the same entry, then it will capture those kind of mistakes. So first objective is to check the accuracy of the postings. So total debits must match with the total credits. And the second objective is to establish a convenient summary of the balances in all ledger accounts for the preparation of financial statements. So here at one place in one page you will have summary of all the accounts. So once this particular trial balance is validated and checked, then simply what will you do? You will pick the number from trial balance and you will put them into respective financial statement wherever you need them. So these are the simple objectives of trial balance. The next question is like, what is the frequency? So frequency depends on like when do you need the data, when do you need a financial statement. And even if suppose you do not want financial statement, but you want to make sure that all the entries which have been entered till this point of time is correct, if you want to confirm that, so you can create a trial balance. So for example, if you are talking about computerized world, so this can be done at daily, like even daily or even after each transaction entry, we can do that. That okay, let's pick all the, just write a line of code which will pick all the relevant balances from an account. So whenever the entry has been made at all the proper places, it's like the complete posting has been done. So after that you can create a trial balance. So it depends. Frequency is totally dependent on when is the requirement for preparing the financial statement, or at any point of time, suppose somebody is coming for auditing in between and they want you to prepare trial balance to show them that everything has been posted correctly. So even at that point of time, trial balance can be prepared. Okay ji, any doubt in the basic understanding of trial balance? Sandeep, Gunjan?
No.
So we already talked about the general convention. So balance sheet accounts are listed first, income statement accounts are listed after that. And one more important point is when we say retained earning, so if you will have retained earning account at the, like retained earning account, is it a balance sheet account or is it a income statement account? Gunjan?
It would be income statement account.
It's a balance sheet account. Okay ji. So if you think about income statement, it is all the revenue, sales revenue and expense account, that's all. So income statement has only sales and expenses. Okay, and what is this? Retained earning is all the sales minus all the expenses. So whatever is left, that is known as net income. Okay, and then it is transferred into balance sheet. So we will talk about that. So just remember that retained earning is a balance sheet. We will see why it is balance sheet account. Okay, but at this point of time, just remember that retained earning is a balance sheet account. And this account, if you look into the trial balance, it will hold the retained earning as at the beginning of the period for which we are making the trial balance. So if suppose we are preparing trial balance on say 31st December 2012. So if you are preparing and the last trial balance was prepared on 31st December 2011. So in this particular trial balance, if you look at retained earning, so it will hold the amount after like whatever was at the beginning of 1st January. So 1st January 2013. So whatever was the balance in the retained earning at the beginning of the period, so that will be here. It's not that. So retained earning is, what is retained earning? It is accumulation of whatever profits you have made from the start of the business. So it is accumulation of all the profit. Okay, and all of the profit belongs to whom? It belongs to the owners of the business. We will see how when we solve the next assignment, you will get clear about this idea. So let's look at a complete accounting cycle. So whatever accounting cycle we have been showing you, there are minor tweaks into that. So first of all, this part is clear to everybody, that transaction occurs and we prepare the document is prepared for the particular transaction. Then we have journal entry, or we say that the data is entered into daybook. Then we talk about posting. So data from the journal goes into general ledger. So that is called posting. And then this is this is done by day-to-day bookkeeper. So you have a bookkeeper, and bookkeeper will be doing all these activities. So day-to-day bookkeeper. So at the end of all, so once all the transactions that occurred in a particular period, they have been posted, so then at that point of time you can prepare unadjusted trial balance. Okay, so we will see what is the meaning of unadjusted trial balance, but for the time being just consider that there are actually, after you prepare the trial balance, then there are some corrections made and some adjusting entries are made to trial balance. Okay, and once these entries are made, we get adjusted trial balance, and once trial balance is adjusted, then you have there is something called closing process. So we will talk about this also. We will talk about adjusting, like what do we mean by adjusting, and once the closing process is complete, we prepare the financial statement. So let's look at what is the meaning of adjusted trial balance. So unadjusted trial balance is just the listing of T accounts and their balances, which have been created, which is created by a day-to-day bookkeeper. But what happens that during the course of a business, there are some entries made into the books which are not quite a good reflection of the economic reality of the transaction. So the meaning is, suppose you have to do a certain things again and again, and you have to make certain judgment about particular transaction, at how much should be the amount. So it's not always the very black and white. So sometimes you have gray areas, and you have to take a call that what should be the amount noted. Okay, so those for the sake of simplicity, so whoever is the day-to-day bookkeeper, they will make some entry, though it may not reflect the economic reality of the transaction, but they will make some entry. And what happens that there will be many such wrong entries made into the book. So all these wrong entries is by design. So when we say by design, what is the meaning? That, see, suppose you have to make such decisions, say one decision every 2 or 3 days, and the day-to-day bookkeeper is not in that position to make the judgment. Okay, so if you call the expert accountant, or if you call the special people who are capable of making those decisions, it will not be effective, cost-wise effective for the organization. So what do? We say that okay, you just take a call. So bookkeeper will just take a call that okay, whatever will come to his mind, that they will make some entry, and at the end of the period, when book is to be verified and clarified and everything is to be very nitty gritty and checked. So at that point of time, whatever a special accountant you need or some people who can attach a particular value, economic value to a particular transaction, so those people are invited, or those people are hired at the end of the period, and then they will make the correct value assignment to a particular entry. So this will increase the efficiency of recording the transaction. So we say that this is by design. Error is induced into bookkeeping by design to improve the efficiency of the whole system and bring down the cost to the organization. Okay, so that is one is, this is called estimations by expert accountant. And then there is something called periodic transactions. So what happens that in day to day you are making all the entries, but there are certain transactions which is not related to any event, but they happen by a particular period. For example, suppose you have lease agreement and the payment is annually. So in day-to-day activities, that is not captured by day-to-day bookkeeper, but at the end of the period you have to take that amount into the book. So there are many periodic expenses, or suppose you have some general expenses and you need to allocate between different departments. So this allocation, if we do at say daily level or at monthly level, it may not be effective to make the judgment. So once again, there are many periodic expenses which are once again decided at the end of the period and by the expert people. Okay, so these are the two types of transactions which we are saying that they are brought into from unadjusted trial balance to adjusted trial balance. So that's why, just look back here, first we prepare unadjusted trial balance and we say that okay, is everything alright, like so whatever transaction entries we have been made by the day-to-day bookkeeper, is it correct or not? So once everything is correct, so his work is done, that okay, so whatever transactions have been made has been entered into the books by bookkeeper, it is correct. So at this stage you announce the good result to the day-to-day bookkeeper, that okay, whatever work you have done, well done, like all the things are matching up. Then expert accountant and expert people for different categories of records, they come into play, and then they make all the adjusting entries and correction entries. Okay, so once they make, and then we prepare the adjusted trial balance. So if there is any differences in the debit balance and credit balance, then we know that okay, whatever problems are there, they are existing in correction entries and adjusted entries. So we do not need to look back into the previous transactions entered by the day-to-day bookkeeper. So if there is any problem in the trial balance here, we will just look into correction and adjusting entries. Okay, Hanji, this is a little bit new concept. So are you guys clear about it? Like what is trial balance, or what is adjusting entries, and what are correction entries?
Yes, sir.
Gunjan?
Yeah, I just wanted to say, I was wondering why do we need to adjust the balance? The first thing is clear that the bookkeeper will do, anyway the bookkeeper will ensure that everything is recorded correctly.
Let's suppose you are working for a construction company. Okay, and that construction is a bridge construction, so say over Ganges river in Patna. Okay, and that will take say 3 years for completion, and the money will be allocated to you by the the government. Okay, at the end of each year, and the decision will be taken by one high like very senior government engineer. So he is not good. So on monthly basis, suppose you are making some kind of data, or say quarterly basis, so that senior engineer is not going to come and assess like how much is the bridge completed, how much the money should be issued to the party who is building, isn't it? It will not be on monthly basis, because it will bring up the cost of hiring that senior engineer who is capable of assessing what percentage of bridge is complete and how much material has been put into it. Okay, so there are many, there are many entries which are just like just enter any particular number. Okay, so the day-to-day bookkeeper is not having a specialized knowledge about attaching a correct value to that transaction. Or suppose you are working in a software company and you are paid on basis of how much code you have written. So obviously bookkeeper or any person will not be having a good idea how much percentage of code is written. So you need an expert software person like who knows how to assess what all functionalities which have been in the requirement document is captured. So that person is not going to come to the office every day. He will come at the end of the period and then he will assign the correct value. Similarly, suppose you are working in an R&D lab. So those kind of things which requires a specialized knowledge, those people are hired, or those people come to the at one point of time and then they make all the corrections.
Okay.
Did you get the idea? So day to day you don't have all the expertise and all the specialized knowledge to take care of that. Gunjan, is it clear to you?
Yeah, Uttam, it's clear now.
So should we move ahead?
Yes, sure.
Okay, ji. Next point is permanent accounts and temporary account. So let's think about balance sheet account. So if I say I have 10 million worth of land, so will it continue and we haven't sold the land, so will it continue year after year in the balance sheet, or we need to close that account? Suppose there is an account called it comes under property, plant and equipment account. Property, plant and equipment. So this account will be, is it a period, like every period it will be zero, or we need to start the fresh beginning, or will it keep continuing from one period to another period? What do you say, Sandeep? Did you get my question?
The transaction is going to complete, like if you are going to sell it, you are going to
Okay, we are not selling, like we have, okay, we are,
the transaction has been made with the received amount has been put into the account, it's not going to change anymore.
yeah. So here we are assuming that we are not selling the land because we have plant on that. So as long as the business entity is present, this land is going to be there on the book. Okay, ji. So the idea is that this account will be there. It will not be like at any point of time it will not be zero balance, like we do not need to make it zero. Okay, but suppose we are assessing the grade of a students, like what grades did you get. So suppose there is like semester program, and suppose you have 2 semester system. So when you have 2 semester system, so in first semester you did very well and you are issued a grade report and you get say A in all the subjects. Suppose for the next semester, do you think that it will carry some weight here in the next semester, or will it be fresh? It will be fresh. So here, so all the students in the next semester are starts from ground zero, isn't it? So what is grade report in case of the business? Gunjan?
It would be temporary account then.
Yeah, it is income statement. Income statement is like the grade sheet of the business, that how much sales you have made, how much revenue, how much profit. So what is the profit? Profit is always related to a particular period. So when we are talking about grade report, we are talking about a particular period, and in each period you are starting from ground zero. Okay, is this point clear to all of you? That at the end of the period you have to do something with the balance. So whatever balance is left, you have to like throw it off. Somewhere you have to throw it off, and then you have to start from fresh. So if you start judging the performance of the business at the beginning of a period, it should be from zero. So those accounts for which we need to make the balance zero at the beginning of the period is known as temporary accounts. And other accounts for like which will be continuation, for example balance sheet accounts. Suppose we are talking about land, so suppose we had 10 million worth of land, so 10 will be there, and it even in the next period. So suppose you are say this is the balance on say 31st December 2011. So even if you prepare the balance sheet on 31st December 2012, this land, and if say suppose there is no purchase of land, there is no sale of land, this will be 10. You know, this is like a snapshot. A balance sheet is a snapshot of what you have at a particular point of time. So how much will be land worth? 10 million, isn't it? So it's not that it needs to be made zero. Similarly, if you have cash, what is the cash at any particular point of time or in the next period? So all the balance sheet accounts, if you look at all the balance sheet accounts, all of them are permanent account. And all, if you look at income statement, since income statement is for a particular period, so at the beginning of the period, the balance in each of the income sheet accounts should be zero. Okay ji? So all of them are temporary accounts. Okay, so let's look at the formal definition of permanent account. Accounts whose balance continue as long as the life of the firm. This means that we keep debiting and crediting in these accounts as transactions happen over the life of the firm. We do not need to consider the period for which we are accounting. So if an account is opened, you just keep entering. Suppose you have cash account. Okay, maybe you want to know the balance at a particular period, so you will just take a, but once again you will continue entering in the data into this. And then temporary accounts whose balance need to be reset to zero at the start of the new accounting period. So all the income statement accounts are temporary accounts. Is this concept of permanent and temporary account clear to you guys?
Yeah.
Good. So once you have understood permanent account and temporary account, then we will talk about closing the books. So what do you think? Should we close the temporary account books or should we close the permanent account? Which will we need to be closed at the end of the period? Temporary. So yeah, so that's the idea behind it. Like we should have a mechanism to make the balance in all the temporary accounts to be zero at the end of the period, and this is what is known as closing the book. Okay, so when we say closing the book, what is the meaning? We are making the balance in the temporary account zero before we start accounting for the next period. Okay, so suppose you have sales, so you have say 1 million sales in a particular year. So how do we make it zero at the end of the year? You know, like so that for the next year when we start making entries, it should be zero. Okay, it will start with zero. So at the beginning of any accounting period, the balance in all temporary accounts should be zero. All the revenue, all the expenses should be zero. So closing the books, what is the meaning? Transferring the balances in all temporary accounts to permanent accounts. So here, in narrow sense, you transfer the revenue and expense, all the revenues and all the expenses into retained earning account, which is a permanent account in a balance sheet. Okay, this process resets the revenue and expense accounts to zero so that they are ready to record the next period's transaction. So actually, before we talk about all those things, let's look at a particular example. This will clarify you. It will give you a better idea. So, are you guys able to see the example?
Yeah.
Okay. So here what we are saying that all the the blue entries are closing entries and all the black entries are what you have. Okay. So for example, in revenue, sales revenue account, you have two entries and you are preparing you are closing on 31st January 2013. Say you have one month period, and at the end of 1 month you want to close the books. Okay, so you have revenue account. Similarly, you have expense account. There are two transactions into COGS expense account. Similarly, for rent expense you have one entry. So there are few entries, and then in retained, okay, just let me do this. And then in the retained earning, the previous year balance, suppose you started the business on 1st January itself. So previous year balance is okay, or suppose you already you have started the business last year and you have some profit in the last year, and the profit is how much? 4,200 is already there in the retained earning last year. Now let's see what we do. So Gunjan, tell me, revenue account, what is the balance at the end of the January month?
Under revenue.
Yeah, before making any closing entry. So how much? So I am just asking you, how much is the total revenue for the month?
It would be 6,000.
Yeah, it is 6,000. So this is here, this is what you have. This is a balance, isn't it? This is a particular format we used for our assignment. We said that there is a balance. You have debit entries, you have credit entries, and then you have balance. So how much balance you have? 6,000. Now,
But actually,
okay, go ahead.
if you see cash sales, why have you written 1,000 then? I mean, I calculated by summation of 1,000 plus 5,000.
Yeah, so this is a particular debit entry and credit entry, and this is a common format that after each entry there is a balance, there is something called balance. Okay, so balance is credit minus debit, and this 6,000 is previous balance plus credit minus debit. Then
Previous balance. Okay.
okay, so if I am working if I am preparing a model for the revenue account in the Excel sheet, how I will model? First, for the first line, I will say this balance is equal to this credit, this cell minus this cell. And how I will fit the formula here? Formula will be this, the previous balance plus credit entry into the new row minus the debit entry. And then I will pull down the formula. So you have, okay, the idea is, okay, leave out modeling part. Just here you have 6,000. So before you start making entry for the February month, you want that balance in this account should be 0. So how do you make it 0? Gunjan, tell me, is it a debit balance or is it a credit balance account, revenue?
It would be a credit balance account.
Good. So it is a credit balance account, and you see here all the entries are credit. So this is a credit balance. So what you do is you make another transaction, and that is called closing transaction. So if the balance is credit here, that is 6,000, you enter a debit entry. You make a debit entry of 6,000. So if you make a debit entry, you must make a credit entry, because in double entry bookkeeping, whenever you are making a transaction, there should be equal debit and credit. So there is a new account created that is known as income summary, and this is one time usage account. So this account is used only at the end of the period. Is this concept clear to you? So income summary is a account which is one time usage account, and whenever we are making the closing entries we use this account. So here we said 6,000. So if you look at revenue, what we will do here, if we did debit, we will credit here. See, this is the credit account, and here this is debit account. Is this part clear to all of to both of you, Sandeep and Gunjan?
Yes.
Similarly, Sandeep, you tell me, COGS expense, is it a debit balance account or credit balance account? COGS or debit balance. And what is the balance at the end of the January month?
2,400.
Yeah, and we want to make it zero. So what should be the entry, nature of the entry? Since this is a debit balance, we will make a credit entry in this account. And if we make a credit entry here, we will make opposite entry, debit entry here. Okay, ji? Is this part clear to both of you? This particular entry?
Yes.
Similarly, rent expense. This is once again, expense is all debit balance, and the balance is $2,000. So I will make a credit entry here, and I will make a debit entry here. So once we have closed these three accounts, we have three entries into income summary. Now what is the balance in the, okay Gunjan, what is the balance at the end of the three closing entry? What is the balance in the income summary account?
It would be
Okay,
debit minus debit.
okay,
I mean,
just give me the number. All the numbers are,
All the debits and all the credits.
yeah, that is right, Gunjan. Give me the number. Yeah, you are right. You are perfectly right.
1,600.
Yeah, you don't need to calculate, like it's already here, isn't it? This is a balance. You have 1,600. Now what do? We need to close this. So what is 1,600? 1,600 is in a way it's a net income. This is the net profit for the business. Okay. So now I want to close this account also. So and what is the nature of the balance you have? This is a debit balance. Okay, because this is more, debit is more. So this is a debit balance, or is it a credit balance? This is a credit balance.
Credit balance.
Credit balance. So we make a debit entry here. This is a credit balance of 1,600. So we make a debit entry here. And in the retained earning account, this is a permanent account. So in the retained earning we make a credit entry. So here debit, here credit. So at the end of the closing process, this is 0, this is 0, this is 0, this is 0, and here you have got one entry into retained earning. So profit for this particular period comes to the retained earning, and this is nothing but your income. In a way, you already got the income statement, and this entry is known as net income. The final closing entry of the income summary is net income, that is 1,600. Are you guys clear about how we closed these books, like 3 books into income summary, and then we close the income summary to transfer the balance amount into retained earning? And now retained earning is containing the profit for 2 periods, for the previous period and for this period also. And retained earning is a credit balance account, because retained earning is nothing but owner's equity account, isn't it? Any doubt in this illustration? Sandeep, any doubt in this illustration?
No.
Gunjan?
Yeah, that's fine.
Okay, ji, good. Okay, so let me just give you that was the practical illustration. So let me just give you the theory part of it. So closing the books is a two-step process. So a single one-time account income summary is created, and balance of each revenue and expense accounts is transferred to income summary account. And the second step is balance amount in the income summary account is transferred to the permanent account, that is retained earnings account. Okay, so that is what we discussed just now, and these are the details. If you look at this particular page, these are the details. So let me just go through it I will not take more than 1 minute in this. Here it says that to close a temporary account, find out the balance in that account. If the balance is a debit balance, create a credit closing entry in that account and a debit entry in the income summary account. If the balance is a credit balance, create a debit closing entry in that account and a credit entry into income summary account. So this is all the lines that are written in blue color is a step 1. Step 1. Step 2 is we are saying that to transfer the balance from the income summary into the retained earning account. And what do we do? In case of credit balance in the income summary account, create a closing debit entry in income summary and credit entry in retained earning. So debit and credit. In case of debit balance, you create a credit entry in income summary and debit entry in retained earning. Okay ji. So once you have closed the books, okay, so now you are ready for generating financial statement. So you have adjusted trial balance, so you know all the things like how much amount you have in what account, and then you pick all the data like all the cash, accounts receivable, retained earning from adjusted trial balance after closing, and plus the closing is done after adjusting plus closing. So after closing, after adjusting and closing the books, so closing is happening after adjusting. This must be clear to you guys. And once you have closed the book, whatever is the balance, you transfer, you pick that up and prepare the balance sheet, income statement, cash flow statement, and a statement of owner's equity, change in owner's equity. Okay, so these are the different. So this preparation, in next few classes we will be talking each and every element of in detail. Like right now we took very simple, just to give you flavor of what is balance sheet, what is income statement. We talked about very simple balance sheet, very simple income statement. But now in next 7-8 classes we will be digging deep into each element of the balance sheet, income statement, cash flow. Okay, so any doubts?
No, sir.
Sandeep?
No, fine.
Prem sir, like, do you want to add something to like whatever we covered today?
Hello.
Prem sir, like, would you like to add something?
I just want to add a couple of things.
Yeah, okay. You can use your blackboard, sir.
Yeah, I Can you see my board?
Yeah, I am able to say it.
Okay. So you see, I think when we were talking about this T account, is it focused?
No, sir, not clearly focused. I think it needs some adjustment. Maybe restart the video, sir. I do not see any difference.
Hello, is it better now?
Not really, sir. What about you guys? Are you guys like able to see it clearly? I think we can go ahead. Like if it is not readable, then we will, it should. Yeah, now it is focused, sir.
Okay, first thing is that when you are talking about key account, this is a mere terminology because the way the ledger is written, it resembles the letter T. And by convention, it is debit and credit. Now, whether on a particular account this side is plus, this side is minus, or this side is minus, or this side is the plus, you should follow the same rule, EID. So if you follow the EID rule, then you will automatically get, in fact, you can do an exercise as a homework that you create a typical asset account, a liability account, an income account, expense account, and an owner equity account. So you can take 5 accounts and then make 5 key accounts for that, following the EID rule.
Actually, that is the next assignment.
So you will see, and maybe I think if you make on a PowerPoint, then Uttam will add those slides into his PowerPoint, because this will be take one asset account, one liability account, one income account, one expense, and one owner equity. So it takes 5 accounts, make 5 key accounts. And all of them will follow the EID rule. The second thing is that now we should be very clear up to the concept of trial balance. I think that is where I think you spend some time, and you have given this assignment to chapter 1 and chapter 2.
No, actually, they have not completed chapter 3 and 4. So, for this week, maybe like let them complete chapter 3 and 4, and the assignment for I have sent them an Excel sheet. So, let them complete this first, and then going forward, we will look into 1 and 2.
Right. So, because you see, if you have any doubt up to the trial balance stage, this is your opportunity to ask. Because if you move forward after the trial balance stage, then getting doubt clarified up to trial balance stage, that will never happen. So even if slightest doubt, apprehension, whatever it is, why it is done like this, it was too many whys to us, that will be very good. So when you read chapter 3 and chapter 4, and subsequently when you will read chapter 1 and chapter 2 also, which will come in subsequently sent to you, then make a list of your questions. And maybe I think whatever questions come to your mind, you flow it. And even if it is a half question, let it be shared. So basically, aid is very important. I mean, once you have understood aid and you have, then you don't have to, rectify. There are some rhythmic rules also which you will find in the book, like what comes is debit and what goes is credit, and like that. But all those things are not relevant once you stick to this aid. And the concept of subsidiary ledger and control account, is this very clear?
Maybe, sir, you just revise them so they will have a better appreciation.
Okay, my question is, why there is a need for a subsidiary ledger?
Sandeep, Gunjan, take a attempt.
Let's say we want to sorry, a particular type of account. If you are going for a cash account, we are actually devoting that account, that ledger for the cash account.
Then we want to add. Yeah, sorry, Sandeep, I interrupted you.
No, I was done.
Suppose we have many suppliers, for example, we are receiving, we have yet to receive multiple, we have multiple, suppose, accounts receivables count. So then
Accounts receivable.
we group together to make it a subsidiary ledger. That is why we need a subsidiary ledger.
Yeah, but the main purpose why we want subsidiary ledger is we want to declutter accounts. You see, it is like this. That today you have 3 suppliers. Okay. There will be another 2 suppliers may be added, tomorrow. One supplier may disappear. So there will be the continuous churning of suppliers. Similarly, for example, employees. Now, if you take advance from the company, then company has to keep account of them. Yes or no?
Yes.
It means, suppose TCS has 250,000 employees. So it means they will have to make 250,000 ledger accounts for each of them. Right?
Yeah.
So what do they do is that they have a concept, but at the end of the day, employee advance, etc. is more like a employee benefit. That's not the main business of TCS. And if that brings so much of clutter in their accounting process of 250,000 employees, then they might as well say, don't give any loan or advances to the employee and buy it. And it is not only just loan and advances. There are so many other things which can happen. And again, advance are of different types. Housing ka advance is to be treated separately. Car advance is to be treated separately. If you have taken like a travel advance when you are going for a trip, it is to be treated separately. When you give back your claim, then again it has to be accounted for. So imagine 250,000 employees, and for one employee there are 4 or 5 different nature of traffic. It is like almost 1 million ledger account will get opened. So therefore, employee account has a subsidiary ledger, and it is not, the main ledger is not cluttered. Main ledger will have only a control account which will be the net total of the position of all the employees put together. So in the control account, it will be in the general ledger, it will only say how much is the total loan outstanding against all employees. Now, there is another concept which I wanted to clarify. There is something called subsidiary ledger and there is something called supplier ledger. And there is something called customer ledger. And there is general ledger. So these are the 3 main ledgers. And correspondingly, there are in accounting, computerized accounting system, there are 3 different modules. This module is called AP, this module is called AR, and this module is called G. Have you heard these names, William? SAP has this terminology, AP, AR, GR. In fact, any accounting system, any ERP system will have some. They might not have heard these names. Now the difference is actually supplier ledger and customer ledger are a kind of subsidiary ledger. They are kind of subsidiary ledger. general ledger can have many, they can have like employee ledger with one of the subsidiary, can be one of the subsidiary ledger, and that will be part of the general ledger. And again, supplier and customer will also find a control account in the general ledger. So at the end of the day, everything is centered around general ledger, and final trial balance you will have to take you from the general ledger. Okay. So you can have two types of subsidiary ledgers. One is special subsidiary ledger like supplier and customer ledgers, which are also have some independent status, or subsidiary to a general ledger account like an employee. So if you just remember these three examples for subsidiary ledger, another example for subsidiary ledger could be building account. Suppose you have an office in Pune, 5 buildings, and you want to keep track of expenses for each separate building. So you can open 5 subsidiary account, one for each building. So by opening a subsidiary ledger, it does not clutter the general ledger, and you can keep expanding the subsidiary ledger depending upon new entities as and when they come into business. I don't know whether I have confused you or clarified some points.
No, sir, it was very good actually. You got to know some extra details.
So basic purpose of subsidiary ledger is decluttering of general ledger. Otherwise, general ledger will become like so unwieldy that normally general ledger should not have because you want to control things. Ultimately, at the end of the day, what is the main purpose you want to know? The whole purpose of accounts is to know what is owner's equity. Owner's equity. This is the final goal. So you just want to know only the one number. You invested $1 million. After 1 year, what is the status of $1 million? Has it become 1.5 or has it become like 0.75? So it has to zero down to only one line of information. That is the final KPI of this whole process. But the process has to be done accurately, auditable, traceable, all those things are required. Okay, I am done.
Okay, ji, Sandeep, Kunjan, any clarification, any doubt, whatever is coming to your mind?
No, sir, as of now, no.
Okay.
Yeah.
Sandeep?
Anis to aap kuch keh rahe hain?
No, sir, I'm just asking Sandeep if he has any doubt related to whatever you talked or I talked in this class or anything.
Okay, back to you, Uttam.
Yeah, okay. Sandeep? Are you there, Sandeep? Hello? Gunjan, are you able to hear me?
Yeah, I'm able to hear you, but I'm not able to hear Sandeep.
Okay now?
Yeah, yes,
Yeah,
Sandeep.
it's better now.
So, anything, Sandeep? Anything? So, were you able to hear Prem, sir?
Yes.
Yeah, okay. So, any doubt pertaining to this class or any other class, we can discuss. Otherwise, I am done.
We have any assignments for this class?
Along with PPT, I sent you the assignment. Okay, so just go through it, and like this is a little bit more abstract, this assignment. So if you are not able to move forward, drop me a mail, or like whenever you get hold of me on a Skype, you guys just ask me, okay, that I am stuck here. So if you are stuck at any point of time, you just ask me. And for input to this assignment, use whatever solutions I have sent to you guys. Okay, do not use your own sheet. Okay, use the solution sheets which I have sent to you earlier. So pull the data from there, the solution sheet to this sheet. So this is actually a general ledger posting exercise, and then we are talking about trial balance, then we are talking about closing the entries. So all the things, so this will take a little bit more time. So I will suggest like spend say 15 or 20 minutes every day. Okay ji.
Okay.
Okay.
Okay, bye.
Okay sir, bye bye, good night to you guys.